Hey everyone, hopefully having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media like we normally do. It's generally related to three different topics: wealth building, commodities, and or financial topics. So we're going to dive right in, take a look, and see what people are sharing. If you want to follow me at Finance Finance, and if you want to join our community, finding-value.com, where I dive deeper into all of these topics looking for potential investment opportunities. I share all those opportunities with everyone on the website or in the community. We have a Discord channel that we do hang out in and chat with other members. I usually participate in it. We also talk about a lot of training, what to look for in companies. How do you tell if something's undervalued or overvalued? I teach the three pillars: ratios, which is pricing an asset versus an asset. I use technical analysis. I also do fundamental analysis. And then we also look at market conditions or cycles. And that's kind of the foundation of the framework of how to find stuff and tell you where you're located value wise. There are other things that we talk about, like portfolio allocation strategies, um, and protecting yourself against riskier companies and stuff like that. So if you're interested, we have a special coupon code. Is that coupon code special? And get yourself a discount. All right, so coming down, we've got XLE, which is an energy ETF, versus Bitcoin. Potential double bottom, perhaps. What we generally see in these patterns is you get a big downtrend. And then when you bottom, you get a potential double bottom. Sometimes this bottom on the right-hand side is a little bit lower. I call that the slingshot, where it slingshots back up. Other times it could be higher too. So knowing where this bottom is on the right-hand side is sometimes tricky. But what we're looking for is a reversal here, where XLE starts to outperform Bitcoin and eventually pass through this horizontal resistance line. The first step is to break the downtrend. That's step one. Step two is to create a higher high. Step three is to create a higher low if you can. And then, step one's the breakout. Step two is a higher low. Step three is to create a higher high. That is a full reversal. And a lot of the times you get these reversal patterns at the bottoms here. The bottoming patterns can be inverted head and shoulders, double bottoms. There's other bottoming patterns too, like Wyckoff accumulation patterns, and there's all sorts of stuff. But this could be the beginning. So what I did is I grabbed another one. This is XLE divided by Ethereum in dollars. The same thing applies here. This is going back to 2015 or so. Downtrend, potential break of the downtrend. And then what we want to do is we get a low, we want to break through. So that's step one. Step two is to create a higher low than this low here. So we want a higher low. And then step three, to seal the deal here, we want to break and create a higher high. That would seal the deal. Now, this is a ratio. So obviously, it could be a combination of XLE going up and Ethereum going down. And that would be perfectly fine for this to rotate into a bull market. And then what I like to do, you use this ratio like this. You say, okay, this ratio looks like it's turning. What I would do is I'd look at the individual sectors of these, like the CTF here. What I see here is I see a three hump consolidation right off the bat. This is the three hump consolidation there. And then we get a bottom. This was the bottom of the commodity to stock ratio as well. And then we went up. We hit resistance at basically a new high. and we've been consolidating in this location here, three hump consolidation generally. We've got resistance that is above us that we are trying to break out, that we haven't broken out yet. Um, this is a bullish formation because we entered from the top or from the bottom side up. Conversely, Ethereum is going to look different. Ethereum, you've got your double bottom here. That's when you want to purchase. You want to purchase if you can here, 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 here. Like that's the ideal entry point. And then you ride it on up. And then what I would do, uh, if you know what you're doing, not saying that I'm going to time it perfectly. Everything looks super easy looking backwards. This here is a shoulder, a head, and a shoulder. And we pulled on back from here. This is a topping pattern. We had another consolidation here. And this consolidation is very similar to this consolidation. It just is scrunched up. So if you were to look, you can draw a line through here, the double bottom, and then you've got a squeeze of a downward facing pattern. We broke upward. So we went up and we are creating a lower high. You guys see that? The lower high. So it's possible that we get into a bear market. But I am not confident in trading Ethereum or Bitcoin because I don't know how they behave in expansionary phase of real estate. I don't know what they do. So my confidence level on all these is 0. I don't know. And even if we had one cycle behind our belt, we still wouldn't know exactly how they behave. But it's behaved in big cycles. Here's their big cycle, pullback, big cycle, pullback. And they all have these double bottom formations, it seems like. And we don't see a double bottom here yet, so it could easily go lower. And when I see that double bottom, if you guys want to know when that occurs, I'll let everybody know. If you want to trade that or play Ethereum and Bitcoin. So looking good for XLE ETF outperforming the S&P 500. And again, here is your bull market in commodities, your bear market in commodities, or bull market in S&P 500. Commodities expensive, equities are cheap, S&P 500 equities. Here's your bottoming pattern, shoulder, head, shoulder. That's a bottoming pattern here. We broke out, and now we've got a downward facing consolidation pattern that has broken out. So what does this mean? It means that we could see another leg higher in energy outperforming the S&P 500. We are doing it right now. We are actively like just starting that move. So what would I do? Well, I'd be scavenging for energy investments, looking to see what's out there. Because when this starts to move higher, you're going to outperform the S&P 500, which is good. Which is good. Here's gold to SPX long term, and maybe it's a falling wedge. This is the pattern here. It goes all the way back to the early 1900s back here. It's a three hump consolidation. And we've recently broken out to the upside on this right-hand side here. So if we break through this line here, it's kind of a fictitious line. I mean, it's there. It looks like a falling wedge to me. It's got the three hump consolidation. If we start to break out and go up here, this is it could be a new paradigm where we are in a hard asset outperforming financial asset world. And this has always been squeezing lower. So since the early 1900s, 1931 onward, we've mainly been in a financial asset world. I was going to say financialized world. Now, if we rotate and we break out of this, it's possible that we are in a hard asset world. It looks completely different than the world that we just came from. If this pattern is, we'll call it legit. Criterion Research says an interesting view from Antero Resources on the reduced ability for coal to gas switching versus what we've seen in 2022. Overall, What they claim is 1.7 billion cubic feet per day of that switching capacity has been retired and won't be in service by year end of 2025. We're digging into the details now to gauge the intel. So this is reduced ability for coal to gas switching. Coal units that have been or expected to be retired in 2025 displaced a total of 650 billion cubic feet of natural gas in 2022 in a high gas price environment. These retirements thus limit coal to gas switching in the current higher natural gas price environment. So what they're saying is the retirements of coal will put a sustained pressure on natural gas. Even if natural gas prices go up, the ability to switch back to coal will not be there after these retirements in 2025. This is only in the United States. There is also uh, very strong demand overseas in India and China. So it doesn't mean that we won't use as much coal, but in America, we may be limited to just how much switching we can do back to coal versus 2022. Marlum says American crude output set to grow significantly per Rystad, but that growth won't be coming from the United States. And this is, I've seen a lot of these projections where United States and a couple of other countries, this one's Brazil, Argentina, and Guyana, will together add 2 million barrels per day of crude production over the next 5 years. But I've also seen other projections where America is growing like 1 million barrels per day. And I'm like, I don't think we've got 1 million barrels per day in us. So what they do is they just change it to somewhere else. Like, oh, they'll do it. Brazil's been struggling to increase production, but maybe the other two, Argentina and Guyana, maybe they'll be able to step up their game. My favorite chart is back. Thank you, JP Morgan. So this is the reported decline of oil. This is the actual reported oil inventories. And this is JPM Global implied. They think it's just going to go straight up. How? Why are they doing this? I don't know where all these projects are, but they just keep showing an upward move. And I do think it's having an impact on oil prices because the sentiment is absolute garbage in oil. And a lot of people, I think what they think is that we have a whole bunch of spare capacity, 4 to 6 million barrels spare capacity, and that oil is plentiful. So even though commercial inventories are down, they're looking at the spare capacity going, well, that's kind of like having inventory, that spare capacity. I don't think the spare capacity is as big as what people think. I think we've got a steady production of 1 to 1.5 million barrels per day that we can kind of step into pretty easily. After that, good luck. And then you also have to fight decline rates around the world. If shale oil has peaked, I think the oil markets are going to struggle to go up over the next few years. That's my guess. Putting on a bet here, it's all about you make all your money on the buy, guys. You make it when you purchase the stock. So when I look at it, it's like, well, we've got inventories that are low. Strategic petroleum reserves are low, and they're probably going to fill those back up at some point, which is extra demand. So inventories across the board are low. We've got cheap oil. Oil is not expensive. It is not accounted for in those low inventory level numbers. So we've got undervalued oil and a cheap gold to oil ratio. I just was looking at oil to the S&P 500, and that's bottomed and ready to go up. This is a pretty compelling entry point based off of valuations in some of the technicals and the ratios. So I think it looks good. That's me. Other people, they wait for breakouts, but I guess I'm just dangerous and aggressive. Spencer Barber says, what people don't understand about this chart is that the fundamentals creating the gap are entirely different today than 17 years ago. I believe this gap will absolutely close again but not in the way that people expect. So this is Home Loan Bill, and he's responding to Danielle DiMartini Booth. It says, question of the day. Why will this disconnect be rectified differently than it was last time the gap closed? In other words, how is this time different? Platitudes understandable in the absence of quantifiable evidence, data and facts, but the latter are so much more welcome. So this is basically affordability. And this is cost to buy a home or investment property going up versus the cost to rent. And she's saying, why will this disconnect be rectified differently than it was last time the gap closed? Well, I don't think it's going to be rectified any differently. The better question is where are we in the cycle? I mean, it's not, this is the wrong question in my opinion. The better question is, why is there a gap? What's causing the gap? And is what's causing the gap still going to cause the gap? So there's a gap, yes, and the gap is bad because we are short homes. It is that simple. And I don't think that gap will rectify itself until the cycle plays out and we build too many homes. So last time this cycle closed here, we went into a hypersupply phase, existing inventory ballooned. We had forced selling from foreclosures and short sales and all that stuff. And that's what happened. None of those conditions exist today. We do not have a foreclosure problem. We do not have easy loans in the system. There are some people talking about the government paying off loans, but it's not that many homes. Even if it's 1,000,000 homes, we could put a full 1,000,000 homes in inventory and we would still be slightly below average. I think we have under 1,000,000 homes in existing home inventory, and I think average is like 2 point something million. A high inventory level is like 4 to 6 million. So yeah, I don't think this gap's going to close anytime soon. And home loan bill, I was looking at this one. It says once again Danielle doesn't get it. The last time was nothing like today. Never before were so many homes either leveraged with mortgage interest rates at 4% or lower, or with no mortgage at all. Also, QM is a thing now, has been since 2011. I don't know what QM is, but yeah, that's what we got going on there, and the conditions are different. So I did guys. I was an engineer back in the day, and I would do a lot of root cause analysis. The root cause analysis that I was trained on, I went to a training. It doesn't mean that this is right or wrong, but Apollo root cause, that's what the name of it was. What they did is they broke it down into actions and conditions. And you could manipulate, you could prevent an action from occurring if you changed the conditions. So, for instance, if you had a cookie on the table and it's in the reach of a dog could walk in the room, eat the cookie off the table, and now you are short a cookie. Well, what could you do to prevent that? And a lot of people they try to fix actions, but that's not the best way to do it. You want to change the conditions. Never put the cookie on the table where the dog can get it. That's what I would do. Put it in a jar, put it up where the dog can't get it. There's all these different things. It's the same thing when you look at the market and you look at all of these people interacting in the market. The way the people interact in the market is subjected to the conditions that they are subjected to. So if you dump a bunch of inflation or a bunch of money printing into the system, people will behave different because they have to with a bunch of inflation in the system versus another market another market condition. Another market condition where there's low inflation and low interest rates, they behave differently. So the patterns that are created in the charts are a function of human beings interacting in markets under certain market conditions. And that's why one of the pillars of something that I use to determine where to invest is market conditions. Because market conditions will change before the humans start to interact with it. And that's where the patterns will eventually come. And that's kind of our confirmation is the patterns and the breakouts and all that stuff. So that's the technical analysis side. The ratios tell you where you're at in the cycle because things are expensive during certain market conditions and they're cheap during other market conditions. So you can tell what's cheap, what's expensive, how the cycle is rotating based off of the market conditions. If there's inflation, increasing interest rates or decreasing interest rates, the yield curve, they're all part of the cycle. And then you can gauge kind of where you're at using all that information. And I don't think she's doing that. Infinite Wisdom says just because the price goes down doesn't mean you're wrong. Just because the price goes up doesn't mean you're right. When you're right when your research and analysis are right. So that's a difficult one. Basically, what he's saying is you could make a call and say, you know what, this is going to go up. And then the price goes up. It doesn't mean you're actually right. You're just guessing and got lucky, perhaps. What you want to do is you want to develop a method or a strategy that works repeatedly and it keeps you on the right side of things the majority of the time. So yeah, you're not going to pick 100% winners. You're going to pick some losers. But if your approach and your strategy is good, you should win on the majority of them, and hopefully you're winning big. So just because you've got a strategy and it's losing in the short term for, let's say, 4, 5, 6 months, doesn't mean you're wrong and it doesn't mean your strategy is bad. And that's where people get all sorts of messed up. Again, the game taught me the game. What does that mean? One of the things that it taught me is, or is and was, is that my time frames were too short back in the day. I needed to lengthen my time frame. Almost all of my shortfalls have been from not holding long enough. Almost all of them. I picked the right companies. I picked them at the right time. I didn't hold long enough. And when I mean long enough, I'm talking like 9, 10, 15-year holding periods or longer. That's the periods that you need to be looking at. Everyone's trying to make money quickly, and that's where they get messed up. The success rate on shorter holding time frames is way, way less than the longer time frames. So you're more likely to lose money and or not make as much. So your time frame is something that is extremely important to become a good investor. You have to get the time frame right. Rick Rule says, if the purchasing power of the US dollar declines by 75%, which I believe it will, then the nominal price of gold will keep pace. And that isn't a $3,000 number, it's a much higher number. Yeah, that's the ability of the system to stay alive by the design of it. So they have to devalue the dollar, and that's going to result in increased commodity prices in gold and silver and all that stuff. It's the dollar going down. Christine Guerrero says, oil executives told Trump they need $80 a barrel oil. So meanwhile, yesterday, President Trump met with the top oil and gas leaders at the first meeting since his inauguration and the creation of the new National Energy Dominance Council. Leading oil and gas executives met with the president. They discussed several topics important to the industry, including the impact tariffs and trade disruptions are having on the industry as a whole. The group met and talked at length about the price necessary to fully unlock much of the production capacity in the United States. The industry has been hesitant to support overproduction, which could drive prices lower, and reiterated that oil needs to be at $80 to unlock the potential of U.S. reserves fully. Participants also expressed concerns about the president's tariff policy and what it could do to demand and raise production costs. That's what they're sharing with him. This one's Rudy. It says, "Oh my God, your grocery bill is about past inflation," says Powell. This is your consumer price index. Do you guys see this going straight up over time? This is from 1990 all the way to 2024. Do you see these huge deflations? They're just little blips. So everybody's worried about deflation when this is the path that we're on. This is all inflation, guys, of the consumer price index. Investment books. It says there's always going to be a reason to sell. Always. And these are all the reasons to sell. 633,000 job lost in March. BP oil spill. There's Chrysler General Motors bankruptcy, flash crash. US stocks fall 20%, gold peaks at 1923. S&P downgrades US debt, most powerful earthquake to ever hit. And this just keeps going up and up and up, which is also what? It's also a function of inflation. Is this. That's what's driving this big move up. So yeah, there's a lot of things that can scare people out of a stock. I tend to avoid and block them out. My strategy is if I lose a couple positions, it'll still be fine and I'll make good money. My position sizing is what protects me. Does every one of these emotional, ill-advised sales left lots of money on the table? Here's global money supply is now close to the record reached in September of 2024. Got gold. Yeah, there's the global money supply. It's increasing since December. Up, up, up. This is our consolidation. Make gold great again. Breaking the Royal Mint. So this is the United Kingdom's official maker of British coins is out of silver bars. Unless it's bars of tea, however, the British won't panic. So the Royal Mint is out of silver bars. This is a big development. Okay. We've got updates here for dry bulk. Capesize up 3%, Panamax up 2%. Tankers, the LCC's down 1%, Suezmax is flat. Shabam Garg says refinery margins in the United States continuing their upward trend as oil product demand remains strong and inventories are drawing every week. Global crude inventories are at decade lows and refineries incentivized to run harder as the crack spread increases, which equals a solid floor price to WTI pricing. So this is crude oil crack spreads. And the spread, what that means is that's the margins of the refiners. So they turn oil into a usable product. They may make a few different products, and that's the margin that they get is the crack spread. That's it. So the higher the crack spread, the more incentivized they are to convert oil into a final product and sell it because they get better margins. They make more money. And this is Jesse here. It says the silver has been slammed every morning for the last 4 trading sessions. That's no coincidence. It's deliberate manipulation to keep silver from breaking out, and I'm crying foul. I can't do anything about this, but you know what I can do? I can go buy physical metal. If they're going to continue to hit it, I don't really care. At some point, the physical metal will go short. So if they're going to give us opportunities to acquire, then screw it, I'm going to acquire. And at some point, it's going to break, it's going to run, and it's going to be a massive run. What I think they're doing is I don't think they're going to stop the move in its entirety. I think they're trying to slow the move down. That's what they're trying to do. They don't want people to panic into it. They don't want people to panic. And that's all I've got for today, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website, special coupon code, and we've got a question and answer session coming up at 5 p.m. Mountain Time Sunday, just as a reminder. So we'll catch you next time. This is Finding Value.